The Nasdaq is closed, and NVIDIA Corporation, NVDA, ended the last trading session on Friday, September 12, 2025, at a closing price of $177.82, marking an intraday gain of $0.65 or 0.37% from the previous close. The common expectation is that a slight positive close, especially in a mega-cap tech name like NVIDIA, indicates business as usual, a steady march forward in the AI revolution. But the reality, lurking beneath this seemingly calm surface, is far more complex and filled with subtle yet significant undercurrents. While the headline numbers look fine, a closer look at the trading session and recent reports reveals a stock that is not only experiencing volatility, but is also grappling with a quiet but fierce reevaluation by the market, where the smallest miss or a seemingly minor data point is amplified, setting up a fascinating tension between the market's insatiable hunger for AI growth and the company's ability to constantly deliver on those stratospheric expectations. The intraday chart on Friday was a microcosm of this tension. After opening slightly higher at $177.77, the stock saw a high of $178.59 before pulling back. Volume for the session was approximately 124.9 million shares, a figure that is below the three-month average of 174 million, suggesting a potential lack of conviction on the upward move. This is a crucial observation. When a stock is in a powerful, undisputed trend, you expect to see volume expand on up days and contract on down days. The recent trading activity shows a different pattern, a more hesitant, sideways consolidation despite the overall positive close. This is the market's silent deliberation, a moment where the story of NVIDIA as an unassailable AI leader is being quietly weighed against the hard data of its daily performance. Institutional activity provides more context. Recent filings show a continued accumulation of NVIDIA stock, with giants like Vanguard and BlackRock holding massive positions. But there are also shifts in their portfolio allocations, and a notable number of institutions have been decreasing their positions. This mixed signal is the essence of the current dynamic. It's not a flight from the stock, but it's a recalibration. The smart money isn't just mindlessly buying the dip, they're dissecting every single detail, from earnings reports to geopolitical risks. This isn't the same blind, exuberant accumulation of a year ago. It's a more discerning, cautious investment, a sign of maturity in the investment landscape around the AI theme. The recent earnings report, released back on August 27th, serves as the prime example of this expectation versus reality dynamic. The company posted adjusted earnings per share of $1.05 and revenue of $46.7 billion, both of which beat analyst estimates. In a vacuum, this should have been a reason for the stock to soar. Instead, the shares slipped in after-hours trading. Why? Because the market had priced in something even better. The key disappointment wasn't the past performance, but the forward guidance. NVIDIA projected fiscal third-quarter revenue of approximately $54 billion, which, while impressive on its own, fell below the most bullish of analyst forecasts that had climbed to over $60 billion. This single data point, the miss on the most optimistic revenue projection, exposed the fragility of the prevailing narrative. The reality of a healthy, yet not impossibly explosive growth trajectory clashed with the market's speculative fantasy. The company's data center revenue, while up a remarkable 56% year-over-year to $41.1 billion, also fell slightly short of some analysts' lofty estimates, reinforcing the idea that even a staggering number isn't enough when the collective imagination runs wild. This is a critical lesson for anyone looking to invest online, whether they're using a self-investing platform or a more structured service like Schwab Intelligent Portfolios. The narrative can often outrun the fundamentals, and a stock's reaction to news isn't always logical if you don't account for what's already been priced in. This is why tools on investing sites, from basic charts on Robinhood stock trading apps to the deep data on an Interactive Brokers trading platform, are so essential for an individual brokerage account. You need to see the real-time movement and volume to truly understand the market's gut reaction. NVIDIA's business model is a masterclass in market capture and diversification, a reality that often gets lost in the breathless focus on its AI dominance. The company's invention of the GPU in 1999 initially revolutionized the PC gaming market, a segment that remains a core part of its business. The GeForce line of GPUs is the gold standard for gamers, and this has provided a stable, high-margin foundation for decades. However, the true game changer has been the pivot to a full-stack AI and accelerated computing company. The data center segment, which now accounts for the vast majority of its revenue, provides GPUs and other hardware for AI, high-performance computing, and cloud infrastructure. The company's CUDA software platform, which allows developers to harness the parallel processing power of its GPUs, has created an ecosystem with significant network effects. They also have a burgeoning presence in professional visualization and the automotive sector, with platforms for autonomous driving and robotics. This multifaceted model is a major competitive moat, as seen in their partnerships with major cloud providers. While companies like Advanced Micro Devices, AMD, and Intel are fierce competitors, no one has the same full-stack offering or the entrenched software ecosystem. This is why so many analysts and platforms, from Fidelity Investments to the SoFi Invest Robo-Advisor, maintain a strong buy rating on the stock, with a price target that suggests a healthy upside. The underlying business is incredibly sound. Looking ahead, the future outlook for NVIDIA remains tied to the core themes of the AI era, but new risks and opportunities are emerging. The demand for generative AI and large language models is insatiable, and the need for NVIDIA's next-generation Blackwell architecture, which they recently unveiled, is a major tailwind. The potential for the company to expand its software and services, creating a more recurring revenue stream, is a key opportunity. This is where an investment platform's focus on diversification, whether it's through Fidelity ETFs or Fidelity mutual funds, becomes particularly relevant. While NVIDIA is a single stock, its performance is a proxy for the entire AI and accelerated computing sector. However, the risks are just as significant. Geopolitical tensions, particularly with regard to export controls to China, pose a constant threat to a major market. The race to develop proprietary AI chips by hyperscalers like Amazon and Google could also erode some of NVIDIA's dominance in the long run. The company must constantly innovate to stay ahead of this threat. The current valuation, with a P/E ratio hovering around 50, reflects the high expectations for continued growth. This is not a value stock, it's a growth stock that requires flawless execution. The question isn't whether NVIDIA will grow, but whether it can grow fast enough to justify a valuation that has already priced in so much future success. It's a high-stakes game of poker, where the company has to keep laying down a better hand than anyone anticipates. The Robinhood app and other individual brokerage platforms have made this kind of high-stakes investing accessible to everyone, but the principles of deep fundamental analysis remain the same, regardless of the tool. Comment below how many shares of NVIDIA stock you currently hold. The story of this company is a powerful reminder of how market psychology can create a disconnect between a company's robust fundamentals and its daily stock performance. The reality is, NVIDIA is a titan of technology, an engine of the next industrial revolution. The expectation is that it can sustain a pace of growth that is, by its very nature, unsustainable in the long run. The current trading behavior, the subtle consolidation, the lower-than-average volume on upswings, and the harsh reaction to seemingly minor misses in guidance is the market beginning to grapple with this reality. This isn't a signal of a coming crash, but rather a transition from a phase of speculative frenzy to one of discerning investment. The company's trajectory remains upward, but the journey will likely be more volatile and less of a straight line than many had come to believe. The era of effortless gains on this stock may be over, replaced by a more nuanced landscape where true investment help is needed to navigate the fine line between a great company and an overextended valuation.